is the Alts Insights podcast hosted by AI Insights. Today we'll cover private placements for the month of October 2019, which was a record month coming off a slow September. Mike Kell, Senior Vice President of Business Development and Program Management, joins Laura Sexton, Senior Director of Program Management at AI Insight, to discuss a status update on Walgreens, the impact of opportunity zones on the marketplace, as well as other key findings and market insights.
Welcome to the Alts Insights podcast, a look at the latest trends we're seeing in the alternative investment universe. AI Insight covers over 200 non-traded alternative investment funds representing nearly $35 billion in assets, and over 80 alternative strategy mutual funds, representing 80% of the AUM of the alternative strategy mutual fund market.
Hello, and thank you for listening. I'm Mike Kell, Senior Vice President, Program Management and Business Development, and I'm joined by my counterpart, Laura Sexton, Senior Director of Program Management, to discuss our most recent private placement industry report as of October 31st, 2019. Laura, can you give me an update on our overall private placement coverage, where we're at today?
Sure, and I think it's important to note, so after we had a very slow September, and after that September, October was actually a record month of new private placements being added to our coverage. So we had 27 new funds added in October after only 6 added in September, which was good. So as of right now, we cover a total of 171 private placements that are currently raising capital. And those funds we cover have an aggregate target raise of $16.2 billion and an aggregate reported raise of the funds they've reported so far, $7.6 billion, or about 47% or so of their target. And our largest coverage areas, as pretty typical, are the 1031 exchanges, where we cover 67 currently raising capital, and then the non-1031 real estate private placements, where we cover 54 funds. We also cover 13 opportunity zones, 8 conservation programs, 11 private equity and debt programs, 6 hedge funds, 6 energy programs, 4 managed futures funds, and 2 preferred offerings. So the 2 areas outside of 1031s and real estate funds that we've seen some pretty big declines in are the energy programs, where in the past we'd have many more at a time that we'd be covering, and then the conservation funds, which are down this year as well. But overall, though, our coverage of funds is up. We've actually added 147 new funds to our platform this year with an aggregate target raise of $992.6 million. So this puts us up about 6% year over year in terms of the number of funds added, and about 3% year over year in terms of the aggregate target raise. And another thing I think that's important to mention this time for this month is that the funds that have closed so far this year seem to be hitting closer to their capital raise targets than in 2018. So far in 2019, we've had 111 private placements that we've covered that have closed, and those funds have reported that they've raised 86% of their target. And last year, in total, we saw 160 private placements close that raised 63% of their target. So this year, fund sizes aren't necessarily smaller. They're not setting smaller sizes to get closer to that target. And in fact, the funds that closed this year so far have been bigger on average than last year. So it seems like a good trend that the funds we're covering appear to be closer to their capital raise targets when they close out. And really overall, things have picked up. We've added 8 more funds to our coverage so far in November, 8 more private placements, and then we've got another 9 coming soon in terms of our coverage.
Yeah, look, I think all great stats there. It's great that we were able to rebound in October compared to what we've seen in September. And I think also looking historically, both November and December are fairly strong months. As you could imagine, November's a bit stronger than December as far as typical private placement ads. So it'll be interesting to see how we do turn out. Obviously, you can see right now, based on our recovery in October, what we're already looking at in November. I'm fairly confident in making the assumption that we'll certainly be ahead. When you compare year-end 2019 to year-end 2018, I think what would be maybe a little bit more interesting is to see how it compares as far as the actual breakdown of the particular funds, the targets, et cetera. But having said that, kind of switching a little bit, all great stats, good information to have. But within those stats, within those private placements that we've seen so far year to date, what kind of trends are you seeing?
Yeah, I think, in terms of trends, I think the non-1031 real estate programs this year are interesting to look at. I mean, coverage in this area, so this is all the real estate private placements that are not 1031s or opportunity zones. I mean, this is a segment that's down a little this year compared to last year, both in terms of the number of funds that we cover and that have been added and their target raise, although we still do cover 54 real estate private placements that are raising capital, which is a decent amount. But the 34 funds that we've added in 2019 have been offered by 25 separate sponsors. I think in this space, there's no dominant sponsor, and we've seen a couple of new entrants, but primarily the funds offered this year have been offered by sponsors that have been around. The new funds this year, we've had about an average target raise of $75 million, but there's a huge range there. So you have some really big funds in the $500 million range, all the way down to even 10, 15 million. So big range and diverse in terms of the target raise, also diverse in terms of the sectors and strategies. You have a pretty big range there. Multifamily is still one of the main sectors represented in the funds we cover. We've seen several different types of multifamily funds, just the core multifamily, but a lot of development. Some of the recent funds actually in the real estate space have been focused on development in multifamily. And then another thing we've seen this year has been a focus on mortgages, and in fact, now that's the largest percentage of the target raise on the real estate side, at about 36% of the target raise in the industry. And then on the other end of the spectrum, we've seen some really small, very targeted funds focused specifically on specific projects, specific sectors, or specific strategies. So very big range in the non-1031 space, a little bit down, which may partially be due to some focus on opportunity zones, shifting away from just kind of the regular real estate into opportunity zones. We've seen obviously growth there, but down a little bit in terms of the number of funds and the target raise there, which I think is kind of interesting.
Yeah, and I think good point. Specific to the opportunity zones, I would say that if you look at kind of aggregate target raise, so the total amount of raise at those particular opportunity zones, so 13 year to date that we've seen through AI Insight, you look at their target raise of just under $2.2 billion, and then you put that kind of in consideration with the other real estate category, which you just touched on as being down this year. And target raise year to date in the other real estate category is closer to $2.1 billion. So I mean, I do think that it's safe to assume that we've certainly, that's an obvious consideration when you think that we are down, because if you were to add that $2.2 billion on the $2.1 billion, I mean, we would actually be ahead of last year, I believe, in target raise.
Absolutely.
And obviously that would boil down to total number of funds and current coverage, et cetera. So certainly an interesting thing to think about. We'll see what happens there in the future. But really kind of let's switch gears a little bit. I think something that's interesting, especially when we're talking about the 1031 market. This obviously applies outside of the 1031 market, but I think from an investor impact, it probably makes sense to talk about it specific to the 1031 market. And that's really about the Walgreens story. Obviously, we've seen these assets held in 1031 exchange real estate deals that really a lot of them have Walgreens in them. So maybe give us a little bit of background on that story, Laura, and what that might mean too.
Yeah, sure. And so for those who haven't seen it, I mean, the latest news with Walgreens is that they are looking at potentially going private. And what they've said so far to the public about that is that the reason they want to do this is because they want to be able to be more strategic, focus on longer-term acquisitions that make sense over the longer term. They also said that in their world, in that kind of the retail world, they need to be able to shift quicker in terms of their strategies. The retail world changes really fast. And what they said was that they can't really do that within the context of the public markets. The public markets aren't able to shift fast enough to keep up with competitors such as Amazon. The public markets, as we know, tend to be focused on shorter-term progress, and it's really a challenge for companies who want to be able to make decisions for the long term when they have to be so focused on quarterly results, which is the case in the public markets. And I think it's interesting for a few reasons. I mean, one, there is a lot of exposure in 1031s. I think things will have to be readjusted here. Debt, anytime you have debt, and you have a change in kind of the way a company is held, there's going to be some changes in the way, the things are structured within, especially 1031s and anywhere that they're held. But the other thing is that this company then comes out of the public markets, and that has implications for the average retail investor out there. I mean, not just the 1031s, but the average retail investor. When a company of this quality comes out of the public markets and is now a privately held company. So it's just an interesting thing. It's one of the reasons why the public markets have declined. I mean, all the reasons that Walgreens cited, the shorter-term focus of the public markets, the inability to be longer-term and more strategic, that's one of the reasons public markets have declined. And private equity has grown twice as fast as public equity since 2002. There's less than half the number of public companies in the U.S., and the average age of those companies, the public companies, has gone from 12 years to 20 years. So you've got kind of the older companies, not fast-moving. So another big company like Walgreens coming out of the public space, I think, is kind of an interesting story. Again, not only because they're a big tenant in the 1031 space, but it also impacts the public markets. And it'll be interesting to see this capital shift from the public to private markets. I mean, this company, so they're a $50 billion company. They're about 4% of the S&P 500. They're definitely big enough to move the market when they have a big up or down day. So that's a lot of money that'll shift. And something to keep in mind, I mean, with fewer and fewer public companies, and especially companies like Walgreens with highly rated debt, it's harder for investors to get access to great companies and management. And I think, again, why the private markets, they have to kind of turn to the private markets to get access to the higher quality companies. It can be difficult to access for the average retail investor. And I think, again, here's where it's something interesting to watch. I think it speaks to one of the reasons why we've seen some of the newer liquid alternatives that have been gaining momentum, such as interval funds, because within this space, it's kind of a public wrapper, but you can actually hold private companies within it. So, maybe a way for investors to get access to some of these companies, like a Walgreens that, right now is public, and they can get access to it in mutual funds or as a stock. But if it goes private, how are you going to get access to it? So this is definitely a story that's been kind of taking shape over the last decade or so, as more and more of these companies look to move private and not have to deal with the confines of the public markets, which tend to be shorter term. I think it's an interesting story to watch and has pretty big implications all over.
Oh, great, Laura. I appreciate the background. And I think that one of the big key takeaways, obviously, is not just the fact, this situation specific to Walgreens, but I think that the higher level theory of what you're seeing of that shift from public to private markets. But for every reason that you mentioned before, I think it's important to note that the regulators are seeing that. SEC Chairman Clayton has been somewhat vocal, if you look at his public speeches, et cetera, about how to bring about that shrinking public market, how to bring access to these private investments to the retail investment community that really needs that access with quality products. So all great points. Again, Laura, I can't thank you enough for your insight and work behind this. Thank you to our audience for listening today, and we certainly look forward to bringing you more valuable content in the near future. Thank you.